Meanwhile, talking about employment, Uber came out with their earnings earlier this morning. And they paid up for their drivers. They said that they did increase their spending in order to attract, I believe, 33% more drivers in order to cater to a record amount of ridership. Joining us now is Mandeep Singh, senior technology analyst at Bloomberg Intelligence. Mandeep, this really highlights the incredible demand for drivers, for Ubers, even at a time when the prices are going up tremendously. How long can it last?
I think it just goes to show that Uber is a clear category leader now, especially when it comes to mobility. On the delivery side, look, they are growing 14% when inflation is high single digit. It's not great growth, and freight is declining business. So everything when it comes to Uber is driven by how well mobility does. And right now there is that summer seasonality, which I think is helping. But when you look past the summer seasonality, the growth is somewhat tapering off because some of it is driven by pricing. Some of it is driven by share gain from Lyft. We know Lyft is growing low single digits. So Uber's category leading position is what's driving this. But I worry about the total end market growth going forward.
There's also a question about consumer pushback on some of the pricing. We were talking about the employment and how a lot of the drivers are getting more when it comes to being lured into work for Uber. You also see prices going up just generally in order to pad their profits. Yeah. Is there pushback? Have we seen it?
Well, so I think the numbers suggest, given the supply growth, right now there isn't a lot of pushback. And look, it's as a platform, it offers you that flexibility that you can work part-time, you can, drive your income. But I still think when it comes to take rates for a platform like this, having 20% plus take rates and not being able to show leverage in your business is worrisome. I mean, Uber is at a run rate of $35 billion a year. So you have to ask yourself, at what rate will this business start generating some serious free cash flow? And right now, you don't see that. The share count is going up. The free cash flow, the adjusted number is, yes, healthy, but it's all driven by mobility. So in the end, you have to ask yourself, is the delivery business really complementary? Is the freight business really additive to the business? And the answer probably is no.
Does the weakness that we saw in the freight aspect point to some other slowdown, whether it's just in general with goods or whether it's a broader consumer discretion, at least, pull back a bit in certain areas?
I mean, with Uber, they're the number 5th or 6th when it comes to the freight side of the business. At least on the mobility side, they're a category leader. And look, the volumes are low. We've seen that with the other transports data that we follow. But look, they're trying to position themselves as a digital company that is a marketplace. It's an asset-light business. It just doesn't reflect that. And the way the business is being run, the insurance costs, I mean, that's a wild card with this business. They will come up with a quarter where the insurance costs just balloon and the margin leverage goes down. So that's where the sustainability of free cash flow or, how this business grows over time, it comes into question because you can have these abrupt quarters where some cost item will spike.
Which is a reason why we end up with a situation where some people are wondering whether the mobility aspect will be purchased by a big auto manufacturer who will then end up running it as a perhaps autonomous driving fleet.